Hello, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving deep into a topic that's become increasingly crucial for anyone stepping into the world of cryptocurrency: managing investment risk. Whether you're just buying your first Bitcoin or already trading altcoins, understanding how to protect your investments is essential. Cryptocurrency is no longer a fringe asset. With developments like Bitcoin ETFs and growing institutional adoption, it's clear that crypto is becoming a permanent part of the financial system. But for many newcomers, the biggest fear isn't volatility, it's safety. You've likely heard the horror stories: wallets drained overnight, people scammed on Telegram, and investors losing everything on a single altcoin. These fears are legitimate, but they're also manageable. Today, we'll walk through investment risk management strategies tailored for crypto, with practical steps anyone can take to protect their money. Let's begin by understanding why crypto security matters more than ever. Unlike traditional banks, there's no help desk or fraud protection when it comes to crypto. You are your own bank. That's empowering, but also risky if you're not careful. What's different about crypto risk? First, transactions are irreversible. Once crypto is sent, you can't undo it. Second, the pseudonymity of the blockchain means scammers can operate without revealing their identity. Third, there's a lack of regulation, resulting in less oversight and fewer protections. Lastly, the high volatility of crypto means gains can be huge, but losses can be instant. So, how do you invest without losing sleep? Let's break it down. Use a hardware wallet to secure your funds. Your crypto wallet is where you store your assets. But if your wallet lives on an exchange or a browser extension, it's exposed to hacks, phishing, and outages. That's why experienced investors recommend moving your coins to a hardware wallet, a device that stores your private keys offline. Popular options include the Ledger Nano X and the Trezor Model T, that these devices keep your assets safe from online hacks. Even if your computer is compromised, your keys stay secure. They're great for long-term holders. Best practices include buying only from the official website, not Amazon or resellers. Write down your seed phrase and store it in multiple secure physical locations. Never take a photo of your recovery phrase. You don't need to be tech savvy. These wallets are beginner-friendly and come with step-by-step guides. Diversify. Don't bet the farm on one coin. Crypto Twitter is full of hype. Influencers often promote the next big altcoin, and it's tempting to chase 100x gains. But putting all your money into a single project, even if it's Ethereum, is dangerous. Diversification reduces your exposure to any one asset tanking. It smooths out volatility across your portfolio and increases your chances of holding a winner. An example diversification for beginners might be 50% Bitcoin, which is the most secure and widely adopted; 25% Ethereum, the foundation of DeFi and NFTs; 15% stablecoins for liquidity and yield farming; and 10% altcoins, which are high risk, high reward, but should be a small portion only. This keeps you in the game even if one asset underperforms. Diversification is how not to lose money in the stock market or crypto. It's timeless advice. Understand position sizing and stop loss strategies. New traders often make the mistake of thinking success comes from picking the right coin. But in reality, the difference between winners and losers often comes down to position sizing and knowing how to set a stop loss. Position sizing is deciding how much of your total capital to put into one trade. The goal is to control risk, not just maximize gains. Use this formula: position size equals account size times percent risk per trade / trade risk in dollar. Let's say you have $5,000 and only want to risk 2% per trade, which is $100. You're buying a coin at $2 and placing a stop loss at $1.50. Your risk per coin is 50 cents. So, $100 divided by 50 cents equals 200 coins. You can use a position sizing calculator to make this easier. A stop loss is a tool that sells your asset automatically if it drops to a set price. This protects you from catastrophic losses if the market turns. For example, you buy ETH at $3,000 and set a stop loss at $2,700, a 10% drop. If ETH drops to $2,700, the system sells your position. This kind of risk management is just as critical in crypto. Use stop losses for any trade, not just high risk altcoins. Avoid scams. Awareness is armor. Scams are everywhere in crypto. The most common ones aren't sophisticated, they just prey on beginners moving too fast. Common scams include fake support accounts on Twitter or Telegram, phishing websites that look like real ones, free airdrops asking for wallet access, pump and dump groups promising easy money, and scam tokens on decentralized exchanges, which anyone can create. The golden rule is never share your private keys or seed phrase, not even with support agents. Protecting your investments means double checking URLs before connecting your wallet, bookmarking trusted sites, and ignoring random DMs or offers that seem too good to be true. And when in doubt, slow down. Crypto rewards patience and punishes impulse. Avoid over-leveraging, the fast track to losing everything. Leverage trading is tempting. Platforms let you borrow 10x, 50x, or even 100x your capital to amplify gains. But for beginners, this is financial Russian roulette. Over-leveraging is dangerous because a 1% price move in the wrong direction can liquidate your position. Your emotional decision-making becomes erratic under pressure, and you often take on more risk than you realize. If you're searching how not to lose money in the stock market, one of the best answers is avoid leverage until you've mastered risk control. If you do explore leverage in the future, start small with 1.5x, 2x max, use tight stop losses, and keep position sizes tiny. Educate yourself continuously. The best risk management tool. Knowledge. Crypto is evolving daily. Projects launch, regulations change, and new security tools emerge. If you want to stay safe and competitive, you have to keep learning. Resources to bookmark include beginner-friendly podcasts that cover technical analysis, psychology, risk, and market news in plain English. Also, consider using a secure, user-friendly trading platform to practice and apply what you learn. Follow credible educators on Twitter, subscribe to newsletters, and watch YouTube channels that focus on education, not influencers pushing coins. Summary: stay smart, stay in the game. Crypto doesn't have to be scary. It just has to be approached smartly. Here's a quick recap of how to invest safely. Use a hardware wallet. Diversify your portfolio to reduce risk. Learn position sizing and apply stop losses. Stay alert for scams. Never over-leverage. Keep learning and updating your strategies. Success in crypto isn't about making one lucky bet. It's about making dozens of smart, cautious decisions over time. Ready to trade smarter, not riskier? Start with a beginner-friendly trading platform like crystalballmarkets.com. Want practical, jargon-free investing tips? Subscribe to a podcast that offers clear insights into the financial markets. That's all for today's episode of Financial Market Insights for Traders. I'm Sophia, and I'll catch you next time. Until then, trade smart and stay safe.